Welcome everybody. Drew Wolf and myself, I'm John Csargo, would like to present year-end tax planning. It's November 20th and we'll be touching on a number of individual and business provisions. As far as how we're divvying up the to-dos on this presentation today, I'll cover the individual provisions. Drew's going to take on business provisions. I'll jump back with the state and gift, and we'll touch on some legislation or more or less pending legislation type issues here at the end too. Biden tax proposal is what I'm trying to say, so we'll get there. What we're talking about today certainly covers three major tax acts coupled back from December 2019. The Disaster Act and the Secure Act, the huge tax act tied into the COVID-19, the CARES Act back in March. And then we've got the Biden tax proposals and what that might mean. We're covering that at the end. So, but we're factoring in the text of a lot of this is certainly those three tax acts. Covering individuals, we're going to first off assess standard deduction allowances. We will walk through options to increase itemized deductions to get potentially more benefit. There's provisions tied into the recent tax acts tied into cancellation of debt, and IRAs and retirement plans can have a huge impact on your taxable income. We'll also spend time on provisions there. We'll manage investment and gains and losses, or we'll talk about ways to manage investment gains and losses and after-tax accounts. So that's the game plan on individual provisions, and we'll start with the standard deductions. Dollar amounts for the standard deductions are right there, $12,004 for single taxpayers, $24,800 married filing, joint, and $18,650. If your itemizable deductions for this tax year are close to your standard deduction, then you can look for ways to increase your itemized deductions to get tax benefit, because anything less than the $24,800 for married filing joint is not providing benefit. Let's assess different ways to do that. Well, if your medical expenses are higher than 7.5% of your adjusted gross income, any expenditures for medical paid by the end of the year are deductible. Now that threshold, by the way, for your 2021s jumping to 10%, not 7.5%. Next up, if you look at mortgage interest and mortgage insurance, an easy one there is you can get 13 months of these deductions, 13 months of interest and mortgage insurance premiums by prepaying December or January 21 by the end of December. So you'll catch those deductions here this year. Mortgage insurance premiums are scheduled to not be deductible in 2021, by the way, barring an extension of the legislation. So next up, state and local taxes. In most cases, we're not going to be able to get benefit for that for our clients because Minnesota is a high tax state and most taxpayers are limited by the cap of $10,000 for state income taxes, real estate taxes, and personal property taxes. So we're probably not going to be able to move the dial on increasing our deductions there. But charitable contributions provide a nice opportunity, and we'll talk about some of the provisions for charitable contributions over the next number of slides, including a donor advised fund. Well, the CARES Act offers two unique opportunities for charitable contributions here. First off, there's an above the line deduction of $300 for charitable contributions in your 2020 only. For those that do itemize, the CARES Act increased the amount that you could deduct to 100% of your adjusted gross income. Most years that's at 60%. So huge allowance for charitable contributions. Now that's cash charitable contributions get the 100%. Where you get full, or substantial benefit is if we're giving appreciated stock. If you give appreciated stock, you can deduct the fair market value of that stock. Stocks, it doesn't have to be stock. It could be shares of mutual fund, exchange traded funds, etc. But the point is that you're not paying tax on the appreciation, but you still get to deduct the full fair market value. If you want to stay in the investment, go ahead and just buy the shares at similar shares to what you donated. Now, you don't get the full 100% limit. That's capped at 30% of adjusted gross income. If it's higher than that dollar amount, the total amount, it'll carry over and provide benefit to other years. The amount will carry over. Let's talk about donor advised funds as part of charitable contributions. You can donate highly appreciated or appreciated stocks, whether it's publicly traded or privately held, to donor advised funds. You can also donate cash to a donor advised fund. What it is, it heads into a fund, and it's a commitment to a charity. The funds can never come back to you at that point, but it's there for charitable purposes. Now, your donation can be invested and grow tax-free, and you get to contribute to the charities either now or whenever you tell the donor advised fund to make a distribution to your said charity. So it can happen anytime. So what's the benefit of stacking deductions? I've got a taxpayer with $450,000 of income. That's a high tax rate taxpayer. Let's say they have $35,000 of tax expense, $10,000 of mortgage interest, $5,000 of charity. With that $10,000 limit for income taxes, that tallies up to 25 grand. Standard deduction is pretty close to that because we're looking at a married filing joint taxpayer here. And remember, the CARES Act allowed a $300 deduction no matter what above the line. So there's absolutely no benefit for where we're at right now with our contributions to charity and our mortgage interest. What if we donate $50,000 into a donor advised fund? In essence, you fund 10 years, assuming $5,000 is your annual contribution. So what we get is a $50,000 increase in deduction. Should reduce our taxable income by $50,000 at the 35% rate. That's a $17,500 federal tax savings today. And then, state will come in on top of it. Once in the donor advised fund, the money's invested, it'll grow tax-free and distributed when you decide. And like I mentioned earlier, if you donate appreciated stock, that provides even more benefit because you're not paying tax on the appreciation. Cancellation of debt relief. The CARES Act allows up to $2 million. If not a married filing joint, it's $1 million of cancellation of debt tied into your qualified resident. If the debt's canceled in 20, or there's a written document that says it's in effect at 12/31. So that ties into troubled times, and we've seen legislation like this over the course of different financial times over the last 20 years. There's a lot tied into retirement plan provisions this year. First off, the CARES Act said no retirement plan distributions are required. The minimum distributions in year 2020. It's a one-year waiver. Another provision that's been out there for years is you can make charitable contributions direct from your IRA to a charity. So it's not coming as taxable income to you and then a charitable deduction. It just goes from your IRA right to the charity. And you can do $100,000 per individual per year. And that's $200,000. Assuming joint tax filers and both spouses do it. This is a qualified charitable distribution, and I mentioned before, it has to come from your IRA to the charity. Another provision tied into the CARES Act, they allowed up to $100,000 to be withdrawn without penalty from retirement plans if it happened in year 20. Now you can repay that within 3 years from the withdrawal date. If it's another provision, I guess the way it works is whatever you take out, you won't pay tax on it in 2020 on the full amount. You will pick it up ratably over 3 years. So whatever that dollar amount is, you'll pick up 1/3 each year from years 20 through 22. So in order to qualify, you have to show that you were impacted by COVID-19, whether that's through you or your dependents have been diagnosed or some financial ramifications tied into the epidemic. The Secure Act also removed an age restriction on making charitable or traditional IRA contributions. It used to be if you were working, had earned income after age 70.5, you couldn't contribute. That's gone now. You can continue to fund IRAs after age 70.5 if you still have earned income, However, be aware that could impact the qualified charitable distribution calculation. If you have a low income tax year, and it could be because of the events of the year, alternatively, relatively speaking, rates are lower than they have been in the past and where they're anticipated to be. So we've got fairly low tax rates. If we want to convert traditional IRAs to Roth IRAs, we can do that. It triggers taxable income at hopefully a fairly low tax rate. And once the funds are in a Roth IRA, at that point, it won't be taxed again. So we just have to watch the various rules tied into Roth IRAs. But so if we have a low income due to the fallout of COVID-19, and it's possible that our securities accounts are a little lower than they had been beforehand. But in any event, we certainly look to those options to increase taxable income. As far as after-tax accounts, as we know, I think, well, certainly there have always been fairly preferential tax rates for assets held for long terms, which are defined as over 12 months. Right now, the maximum rate on long-term capital gains for most of us is 15% for federal purposes, and it can bump up to 20% for those at the top tax bracket. And there's also a net investment income tax that can apply at higher income levels. But those rates are very favorable. 15% rate for federal is excellent. And to the extent you happen to have capital losses that were recognized this year, you can go ahead and shelter it by selling any losers. Harvest the capital losses. So you can manage it one way or the other, I guess. And that's what we're talking about here. Realized losses on investment in taxable account. More or less, we have securities that have lost. Go ahead and take the benefit of that. If we sell, generate more losses in income, it's really not that significant. We can offset $3,000 of ordinary income, and the excess carries over to the next years. So it allows flexibility in the future. So a lot of times we're looking as to manage capital gains and losses. In addition to those favorable tax rates of 15% on long-term capital gains or qualified dividends, it gets even better for taxpayers that are in the low tax brackets, and taxable income of 40,000 or less on singles, and joint at 80. You can see the dollar amounts, 0% tax on those rates. Minnesota, the states generally don't provide the 0%, but federal tax at 0. So take advantage, manage to get benefit for that. So if we want to take advantage of that 0% rate, but our income's too high, and we're thinking of doing a gift to someone, we could certainly look to gift them appreciated stock. They get our tax basis. They could pick up the gain and potentially pay 0% on that gain for federal purposes. Now, it happens to be your child, age 24. Kitty tax rules are around that more or less come back and hit it at the parent's tax rate. So we have to watch out for the kitty tax rules in this case. But there's a 0% rate that we certainly should be looking at. Drew, will you take over and cover the business provisions?
Of course. Thanks, John. Like John mentioned, I'm Drew Wolf. I've been with Boyman Berenshire for about 5 years now, and I'm going to go through some year-end planning moves for businesses. Below are just a few of the items that we'll touch on today. We'll start with PPP loan forgiveness, move on to net operating losses, go to a nice new credit provided by the Secure Act for a retirement plan. We're going to go to depreciation. We're going to touch on the timing of income and deductions. Then we're going to talk a little bit about a sneaky part of the Tax Cuts and Jobs Act, which is the business interest expense limitation. Then we're going to round it out by talking about QBI. So first off here, we're going to talk about the PPP loan forgiveness and how that factors into year-end tax planning. If you're looking for a deep dive on the PPP loan, I would suggest going to a previous webinar that we did a couple weeks ago that was done by our PPP team. They'll really go into, a lot of the intricacies of the PPP loan. I'm just here to talk about how it's going to affect the year-end tax planning. So the PPP loan forgiveness and the forgiveness of the loan is not a taxable event, but where an issue lies is the deductibility of the expenses that you use the PPP loan for, and whether or not those expenses are deductible or not. So we just got word, just as a matter of a couple of days ago, from the IRS stating that the PPP expenses, or expenses that were funded by the PPP loan, are non-deductible in the year that they're paid, 2020. So in order to change that, and we still think that there could be a change in that ruling, it would have to come from a congressional act. So we'll really just keep you up to date as much as we can. But as it states right now, the expenses that were funded by PPP loan will not be deducted. Next, we're going to touch on net operating losses. So there was a change with the CARES Act stating that you can carry your net operating loss back 5 years. So in the year here, 2020, if you file your return and you had a difficult year, as many people have, you can now carry that back 5 years to receive more of an immediate benefit. Previously, under the Tax Cuts and Jobs Act, you would have needed to wait because there was no carry back, there was only a carry forward. So now, when we get done with the 2020 return, the 2019 return, I guess, and we see there's net operating loss, you can receive more of an immediate benefit by carrying that back 5 years. A couple of other changes with net operating losses. One was that under the Tax Cuts and Jobs Act, even if you had an NOL, you could only carry forward and utilize 80% of that against your taxable income. So no matter what, there'd always be some taxable income remaining and you'd have to pay tax, even when utilizing your net operating loss from a previous period. Another change was the elimination of the excess business loss rules. So this had stated that you're only able to utilize $500,000 if you're married filing jointly of your business loss against non-business income. So that was eliminated for the years 18, 19, and 20. So when you carry back a net operating loss, say from 2019, then you'll be able to utilize the full thing. There won't be any limitations as far as the 80% rule goes or the excess business loss rules. Okay, next we're going to talk about the new credit put in place by the SECURE Act for a new retirement plan. So if you've considered starting up a retirement plan this year and for the next 3 years would be a good time to do it. So the credit is based on the cost to set up the plan. And like I said, it's available for 3 years. So the qualified costs would be the cost to set up the plan and also to educate the employees about the plan. So there's 50% of those costs would be eligible for a credit to a maximum of $5,000. As well, there's a credit for auto enrollment of $500, and that's available for each of the next 3 years. So if you're able to take advantage of both of those, then your total credit after 3 years could be $16,500. So a really nice incentive to set up a retirement plan. Okay, now we're going to talk about depreciation. And this is always one of the big year-end planning decisions. You know, do you go out and get a new vehicle or purchase equipment at the end of the year to see if you can drive down your taxable income? And it's very easy to do so now with the latest depreciation rules. So put in place by the Tax Cuts and Jobs Act was 100% deduction in the year it was placed in service. So there's no more, you know, depreciating over a certain number of years if you don't have to. You get that immediate benefit in the year that you put the property in service. Another big change was for qualified improvement property. And when you think qualified improvement property, really think like a remodel or something like that. This was an error originally in the Tax Cuts and Jobs Act. So the initial wanting was to have this qualified improvement property be eligible for that immediate benefit, that immediate 100% first year deduction. However, when they pushed out the law, it was just one of the things that it was just an error, and due to that error, anything placed in service like a remodel would then receive 39-year life and not be eligible for bonus. So they were able to correct that in the CARES Act. So anything that was a remodel in, it would be 18 and 19 is now eligible for that immediate benefit. So if you have something like that back in 18, contact whoever your advisor is. We're also on the lookout for those items. So we have the ability to either amend or correct it in the 2019 return as well for remodels that were done back in 2018. Yes, and I had mentioned vehicles in the previous slide, but there's a bigger distinction between the more of the luxury automobiles and the heavier SUVs, pickups, and other kinds of trucks. So the benefit being vehicles that are over 6,000 pounds. It's important for vehicles over 6,000 pounds because they're able to receive an immediate deduction, whereas those luxury automobiles, you'll have to spread it over time. And this slide here shows just the difference there. Whereas if you get an SUV and you place it in service yet here in 2020, then you'll be able to receive an immediate deduction for it. Whereas you do it with a luxury sedan, then you'll be limited to about 18,000 here in the first year and 16,000 next year, and you can see how it goes down year after year. But really, what the difference is that you'll get the full depreciation either way. You just get more of an immediate benefit if you choose to purchase, an SUV or a truck or anything else that's over that 6,000 pounds. Okay, now we can move on to section 179, and that has a lot of the same benefits as the new rules for bonus, where you get an immediate benefit, an immediate deduction for the property placed in service. And you can see there below at that the second point, where there is actually a limitation on SUVs for section 179. That's capped out at $25,000, and luxury automobiles, they have the same limitation on them. So again, a lot of the same rules and concepts as bonus, with limitations on vehicles. However, as we talked about before, you can use bonus depreciation on an SUV to get that immediate benefit. But the section 179 is capped out at $25,000. And 179 is now more important because Minnesota conformed to the section 179 rules. So previously, Minnesota had said that you get a $25,000 deduction off the top, an additional 20% for your 179 deduction, but that remaining 80% was then taken over the next 5 years. So again, you get the full deduction, however, it's really just spaced out over time. Well, now Minnesota said that you're eligible for the full deduction right away. And bonus has a lot of the same rules that the section 179 rules used to have in Minnesota. So for items placed in service and that utilize bonus depreciation, well, they had an 80% add back. So 20% was a deduction in the first year, and then that remaining 80% was taken over the next 5 years. So, section 179 is really going to be important. We're going to depreciate more assets over using the Section 179 rules just because of this Minnesota conformity. So a pretty big change here. Okay, the next thing that we're going to talk about are the timing of business income and deductions. So really, if you're a cash basis taxpayer, you're really going to try and pay your expenses here before year end, try and get that benefit here in 2020. And then if you're an accrual basis taxpayer, look for things that have happened here in 20, but you won't be paying until 2021, and see if you can accrue those items to receive a deduction. And it's really about trying to find, where your tax bracket is this year versus next year. Maybe your tax bracket is already low enough this year because of this current circumstances. So maybe you consider flipping it the other way around, where you're trying to, pick up income this year, so you don't have to pick it up next year when maybe you'll be in a higher tax bracket. But generally, the thought is, to capture the expenses this year, so you can get a more immediate tax benefit. Okay, now we're going to touch on a sneaky little part of the Tax Cuts and Jobs Act, which is the business interest expense limitation. There was a heavier limitation put into place this year of 30%, and that's been adjusted to 50% now under the CARES Act for this year, but it is going to go back to 30% in 2021. It's not exactly a simple calculation to figure out the expense limitation. However, I do want to make you aware that it is out there, and it is a part of the law. Luckily for most of you, it won't be, so much of an issue, because you have to exceed $26 million worth of gross receipts for the past 3 years for this to come into effect. So that'll exclude a good chunk of you and the rest of our clients. However, there is another part of it, and that is the it has to deal with losses. And if you pass on your loss to 35% or more shareholders that are passive, so if it's called being a tax shelter. So if you're a tax shelter and you have a loss and 35% or more of your loss is going to passive shareholders, you're also going to be subject to this limitation. So, if that's your situation for this year, and you have interest expense that you're going to deduct, maybe it's worth considering, paying more of your loans down this year, capturing more of that interest expense, so that maybe you won't be faced with a limitation because, the principal of the loan had gone down. So it's really kind of trying to pay that down if you have the funds available, which is a little bit more difficult in this current environment. Okay, next we're going to talk about QBI. And one of the bigger parts of the Tax Cuts and Jobs Act was the QBI deduction. And this slide just kind of looks at the basics of what the QBI deduction is. Overall, very surface level, is that it's a 20% deduction for business owners based on their business income. One caveat is that the activity must rise to the level of a trade or business, basically stating that you have to be engaged in the business for a profit. The next point is an income threshold. So anything underneath the $300,000 number, 326,000 to be more exact, any income from a business, if your taxable income is underneath the 326,000, then income from any business will have the 20% deduction automatically. And if you're curious what the two numbers are, the 326 versus the 163, the 326 is if you're married filing jointly, and then the 163 is if you're single. So just a distinction there between the two limitations. But again, if your taxable income is underneath that, your business income will receive that 20% deduction, regardless if it's a specified service or not. The next point there talks about the specified services. So you'll be limited in your deduction if you have a specified service. And those really just think about true services like health services, lawyers, other professional professions, financial services. And there's kind of a gray area of consulting, but they say consulting is another specified service. So that 326 to 426 is kind of a threshold limitation. So the deduction will be phased out if you're a specified service, if your income, your taxable income falls within those limitations. However, if you're not a specified service and you're past the $426,000 limitation, you're going to be hit with another separate limitation. And that states that your QBI deduction cannot exceed the greater of 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% of asset basis. So again, yeah, that's you're kind of hit with limitations all over the place. And you're not done then either, because there's a final limitation stating that your deduction can't exceed 20% of your overall taxable income either. So again, it's a big part of the law, but limitations really kind of all over the place. So we have some tax planning ideas to try and get you out of these limitations so that you're able to get a full QBI deduction. So the first two bullet points there relate to the W-2 wage limitation that I was speaking about before. We have an example in the next slide about giving S-Corp owners a year-end bonus if they're faced with that limitation. But for partnerships, it's a little bit different because you can't exactly give a partner within the partnership a year-end bonus because they don't receive a W-2, so their wages don't apply when we're speaking about the 50% limitation. So for that bullet point, in your partnership, consider hiring consultants as employees to try and drive up that W-2 wage expense. The next point there, relates to maybe you're already an employee and you're receiving a W-2 and you've considered becoming a consultant. Maybe the QBI deduction is a good incentive to go forward with those plans because you do receive a 20% deduction as long as your income is below the income threshold. The next point there states, if you're a specified service, then really try and drive down that income because maybe you're within that income threshold. And the further you get to being out of the income threshold on the low side, trying to get it beneath 326,000, well, then it's just an added benefit because not only are you receiving a tax benefit for driving down your overall business income, but then you're also increasing that QBI limit or the QBI deduction. So you really kind of get the best of both worlds in that situation. Another idea would be to make a retirement contribution, just, really any way to try and drive down that taxable income. You can use the ideas that John presented before with the donor advised fund and other ways to increase your itemized deductions. And the final point there, which we'll touch on, is consider aggregating businesses. So yeah, maybe we'll just wait a slide to talk about that. But first, I had mentioned that we have an example of utilizing year-end bonuses for S-Corp owners. And this is a situation that we faced earlier this year. So the column there on the left deals with the situation before we placed a bonus for the S-Corp owners. But this business had income of $3.5 million, but only $125,000 worth of wages with no property to go along with it. So taking those facts, our QBI deduction was $62,500. Well, how do we get there? Well, we'd have to compare our regular deduction, the 3.5 million times 20%, against the wage limitation. So I think it's pretty obvious, even just by eyeballing it, that we were going to be limited because our wages weren't high enough. So that's how we get our $62,500. That was taking our $125,000 of wages and multiplying it by that 50% limitation. So that's going to still generate some tax savings, but only $23,000 worth. So as part of our planning, we decided that we were going to offer, we're going to present an idea of a $1 million bonus. Now there were 2 S-Corp owners, so we each gave them a $500,000 bonus. So in order to do that, our income was driven down by the additional wages and by payroll taxes. So then we arrived at an overall income of $2.4 million. Our wages are $1.1 million, and still property of nothing. So now our QBI deduction is $495,000, and that is the 2.4 multiplied by 20%, because we've now cleared our wages limitation. The wages multiplied by 50% is, well, probably about $500,500 or so. So we've cleared that. And that means our income tax savings are $183,000. And we arrived there by taking the $495,000 QBI deduction and multiplied it by our top federal tax rate of 37%. Now, we did have to incur additional payroll taxes in order to get that deduction. So the additional costs that we had were about $65,000. But still, comparing that against our income tax savings left us with a net savings of $117,000. This is a pretty extreme example, but it just really shows what the power of the QBI deduction can give you. So anytime we see a scenario where we can maximize that QBI deduction, we're going to present that as an idea, because this is a good example why. Okay, now we're going to just touch on aggregation. It's definitely the most complex and confusing part of the QBI deduction. But basically what it says is that if you own multiple businesses, you can attempt to combine those businesses so that you can try and maximize your deduction. So when we talk about that, we're combining the income from the businesses along with wages and those, the asset basis. So maybe that's an alternative to presenting an S-Corp with an idea of a year-end bonus. Because if you can, group together another business, it will give you a full deduction without having to spend money on those additional payroll taxes. But it's not necessarily as easy as just you have 2 businesses, so let's just combine them to try and maximize the deduction. So we have a couple of categories here of qualifications. The first set here are the 4 qualifications that you have to meet, and they're not very subjective. The first bullet point there states that the same person or group of people have to own 50% or more of each business that is being aggregated or grouped together. The second point there states that the ownership must exist for the majority of the year and including the last day of the year. The third point states that the trades or businesses all must have the same tax year. And then finally, neither of the businesses being grouped together can be a specified service or business. And then we move on to the second set of qualifications there, and you have to meet 2 out of 3 of those final qualifications. And these are more subjective, or you can make an argument for one way or the other. So this is really where we spend a lot of our time debating whether or not, we can group certain businesses together or not. I think a common way to understand this, or a good example, is a restaurant and a food truck. So we'll kind of talk through those while we look at these next 3 points. The first point states that products, property, or services are typically offered together. And I think that's fairly common within the restaurant industry, where they have the physical location, the standard location, and then they'll send out a food truck to different kinds of events or, a different place. And they still offer, or it's just really common to see something like that. The second point there states that they have to share the same centralized business elements. So what they're talking about there is really like office location, management, accounting, bookkeeping, things like that, where they kind of have to be managed by the same person or group of people. The final point there is they have to operate in coordination with businesses together. So in our restaurant and food truck example, the food truck is really getting their ingredients, their recipe, and the products that they're offering really come from the restaurant itself. They just, put the restaurant on wheels basically to get it somewhere else, but they operate in coordination with each other. So really it's just about understanding, some of the basics of aggregation and reaching out to your tax person and asking the question. And maybe we'll ask questions of you. You might think, well, why are they asking me this? Well, this is why, to see if we can aggregate a couple of businesses together to see if we can maximize that QBI deduction. Okay, and with that, I am going to throw it back to John, and he's going to talk about estates and gifts, among a few other things.
Thanks so much, Drew. Good coverage on a lot of those business provisions. So wrapping up here with the last section on estates and gifts. The federal estate exemption's fairly high at $11.58 million this year. The state tax for federal is virtually 40%. Gift tax rules tie in with the state tax rules, and we all know there's an annual exclusion, and that is $15,000. So now the increased federal exemption was part of the Tax Cut and Jobs Act that expires at the end of 2025. So we expect its index for inflation is probably going to be about 6 million. So higher federal exemptions now. So if we're considering gifting and things along that line, it's a good time to do it. For Minnesota purposes, our estate exemption is 3 million. The state estate tax ranges between 13 and 16%. Most higher tax rate obviously hit at 16%. If you happen to gift, Minnesota, you can gift without eating into your exemption, but there is a 3-year look back on gifts. And the last provision is if you happen to have a small business, and it also includes small farms, that you're active in and the beneficiaries would be active in, there's an increased exemption for a qualified business of up to 2 million. So in essence, you're at 5 million. So what to think about tied into the federal estate taxes is if they're higher exemption amounts now. Gifting certainly can be a very good idea if we're thinking about that. We also have to consider other issues, though. It's not the only issue because there are income tax things to consider. But before walking through all that, we want to be part of the consultative team to help assess whether we should do it or not. Continuing on. 1 second. The Biden tax proposals. Well, while Joe Biden was campaigning, he said his tax would be more or less, an increase in taxes would tie into those making $400,000 of income or more. And for those, he'd increase the ordinary income tax brackets. He'd eliminate that qualified business income deduction that Drew spent some time on. And he'd eliminate the benefits of like-kind exchanges, which allows you to trade real estate without picking up tax on the gain to the extent you don't get cash. So those are targeted to 400,000 or more. For taxpayers over $1 million, the qualified dividends and long-term capital gains rate, we talked about preferential rates, those would not apply. Also, we talked about itemizing deductions and bunching and applying more or less knocking down your taxable income. Well, the way Joe Biden's proposals would go, he capped the benefit of that by valuing the itemized deductions and applying a 28% rate to get a credit. So you wouldn't get as much benefit is what that comes down to. Similar calculation with retirement contributions, just a calculation of the contribution at a 26% rate instead of whatever your tax rate might happen to be is the way it works right now. Increase in child and dependent care credits, and dollar amounts are there from $3,000 to $8,000 for one child and twice that for 2 or more kids. First-time home buyer credit up to $15,000. That's refundable and advanceable. That similar type of stuff has been in play in past years. A caregiver credit for informal long-term caregivers of up to $5,000, but you know, obviously there's some definitions needed. Expansion or the child tax credit would go up from $2,000, proposed up at $3,600 if the child's under age 6, and $3,000 for other children under age 17. Big issue with Joe Biden is what he's proposing on estate taxes. So he's usually when a person passes, the value of the assets are now the new basis in that property. And in essence, Joe Biden says, no, you go back to that person's cost in the property. So no step up in basis, which is going to be huge, certainly for a record keeping perspective. How do we know what the decedent paid for various assets? So that will certainly be a hurdle as that comes through legislation, because we know to try to implement that will be a problem. And Joe Biden says he's also proposing reduction in that is federal estate tax exemption that we talked about, 11.58 to 5.79. So what happens, regardless of which candidate elected president, states haven't certified yet, but we expect certainly Joe Biden to be president. Do we have a status quo Congress? Senate, we'll see. There's 2 runoff elections in Georgia that will decide it. Democrats have to win both to create a tie. Democrats do control the House. If there is a divided government, there will be gridlock. And with gridlock, the Tax Cut and Jobs Act should be around until there's another election to potentially change the makeup. Let's take a little look into Georgia. The runoff is early January, the 5th. The November results, the Republican from one party or one of the races was just under the 50% required to win outright without a runoff. So they'll be hotly contested. And there were 2 Republicans against a Democrat. They had combined in the other Senate race for 45% to 33%. Democrats have to win both. There is no presidential election on the top of the ballot, so it could be a lower turnout. And typically a lower turnout would favor the Republican Party, but there are a lot of funds pouring into the Georgia race, most certainly. Even if there is a tie, there's still a filibuster provision, which certainly can slow down tax law changes. So from today's session, there are some suggestions to look at. First off, we touched on higher standard deductions. And are there strategies to take itemized deductions and make them more beneficial, get them higher than the standard? And we talked about charities being a big part of that and donor advised funds. We talked about IRAs and retirement plans and how that can impact your income. Outside of this, on the individual side, we certainly have Roth conversions and IRA contributions. There's ways to manage taxable accounts to vary your tax rates. And then on the business side, we talked about assessing the impact of the PPP loan forgiveness and watch for additional guidance, which is a law change by Congress right now. We know that expenses aren't deductible. Retirement plans inside a business can decrease your income, which can provide many benefits on multiple levels. Drew also touched on depreciation choices, which are huge for tax planning. And then there's the gotcha, watch out for the business interest expense limit. So we have to be always keeping that in mind. And then one of the big benefits for businesses is the QBI deduction. And we'll be looking to the impact of future legislation and Georgia runoff coming up to help, I guess, kick that off a little bit. In any event, both Drew and I appreciate you taking the time to go through this seminar with us, and most certainly feel free to contact either one of us with questions tied into that, or any member of your team here at Boyer & Berenshire. Thank you.
Thanks, everybody.